Well, it does feel like there's room for it to fall further from here, doesn't it? We've gone within a couple of weeks from a market that was just starting to believe that these central banks could deliver a soft landing, I think, to a market that recognises that at best they can sort of land this thing on the proverbial Hudson. In our view, there is still room here for some earnings downgrades as we head into what will be a likely recession. So we're at the moment sort of gripping the side rails and holding on through the summer.
Yeah, very interesting. You're making some changes here, Charlie, backing away from small cap exposure in the UK.
Yeah, I mean, look, we tried to hold on in diversified portfolios to some risk in this situation because, of course, you know, let's hope these central banks get this right. Let's hope they avoid recession and we can start to move higher. But there comes a point at which I think you have to acknowledge that the probability of recession has got so high that you need to take out remaining sources of risk in portfolios. And the bit we held on to was UK and some European small caps. So we've taken that out. We've benchmarked that. And as I say, what we do believe, though, and I think this is a positive for anyone with a diversified portfolio, is we do think that yields have probably got, you know, roughly as high as they're likely to get. And so at least if you're running a diversified portfolio, you should hopefully have some stuff in it that starts to work now, which would be rather different to the start of this year.
It's an interesting call to call the top of the yields here, but I'm interested in gold. You talked about taking things out of portfolios. You're adding gold back in at this point, but not because you think it's an inflation hedge, I don't think.
No, I mean, gold obviously can operate as an inflation hedge, but there's no particular reason why it has to. Really, for us, we see it as a sort of source of duration within the portfolio. We were very short duration for much of the last year, but now we believe that it's time to introduce some duration and some portfolio protection back in as we move into the next stage. Now, you can choose to do that through long-dated index-linked gilts or US Treasury bonds, or you can choose to do it with gold. And I think where we stand at the moment, we just think that the pricing on gold is a bit more attractive.
Can I take a step back? You and Jeff talking about yields having peaked. What yields have peaked? You're not talking about sovereigns, are you? Because we've got basically record amounts of debt at European sovereigns now. We have record levels of inflation, almost record levels of negative interest rates as well. And a need, of course, to carry on extending maturities at very unfavourable terms, and a central bank that's apparently more hawkish. Are you talking about sovereigns having peaked?
Well, firstly, we're never claiming that we're going to know exactly when a peak is. We're trying to be roughly in the right place on these things. We've been very short duration for a long time. But in our view, what we have seen is inflation expectations now largely catch up with where the bond market needs to be. It's been a process, as you know, of quite rapid catch up in the last few months, and we think it's roughly where it needs to be now. Yes, but you've always got to remember that whenever you don't have bonds in your portfolios and you don't have some duration in your portfolios, you're running a big risk that if the central banks push this too far, they plunge us into a nasty recession, you won't have the protection in your portfolio that you need in a deflationary environment. So you can always congratulate yourself for not owning any bonds when bonds have gone down, but it's like running a car without insurance. Ultimately, these are the things that we believe will still work in a deflationary shock. And there's got to be at least a meaningful chance that these central bankers have to push this so far that that's what they generate.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.